My job as the leader of Berkshire Hathaway is to have visions and goals for the company overall with a long time horizon attached to them, and then to get those goals accomplished through other people.
Investing isn't as easy as it seems, but fortunately, the godfather of modern-day investment has come to our rescue. During an interview with popular journalist Andrew Serwer, Berkshire Hathaway billionaire CEO Warren Buffett revealed the right formula for a profitable investment. The good news is that beginners and experts can successfully utilize these strategies, which I will discuss in this video. Let's get started. Buffett required little to no introduction. He has been running Berkshire Hathaway for nearly 60 years, which owned over 50 companies like Gelco and Dairy Queen, with minority stakes in Apple, Coca-Cola, and many others. His $120.6 billion fortune makes him one of the richest men in the world. Although Buffett has never written any book, he has shared his investment strategy with the public for over 70 years through his speeches, writing, and investments. He revealed his strategy to attain financial success and how he mastered the market many times, one of them being during his interview with former Yahoo Finance editor-in-chief Andrew Serwer. The first thing he mentioned is to invest in companies you know. One of Buffett's key principles is investing in companies in an industry he knows a lot about and likewise a familiar business model. This understanding will make judging a company's potential and its product or service much easier. Buffett invests in companies with very recognizable brand names, so it is difficult for competitors to take away their market share, no matter how much capital they have. One example of a current Berkshire holding that meets this criterion is Coca-Cola, whose name is ingrained in the culture of America and other parts of the world. The company has operations in over 200 nations through its vast distribution network, and its products can be found everywhere around the globe. During the first quarter of 2023, Coca-Cola reported a total revenue of $10.98 billion, representing a 4.66% increase compared to the previous year. They generated $43 billion in revenue in 2022 compared to $38 billion in 2021. In addition, Buffett also likes firms whose products are simple for an investor to understand, food and razors, to name a few. Suppose you're already running a business before trying to expand. In that case, you may have greater insight, giving you a better chance of success. However, first-hand knowledge is not essential. What is essential is a rigorous, fact-based, and systematic approach that goes beyond mere gut feeling and speculation. You should also be confident that your chosen company has strong values for success and a solid financial record. After all, every investment carries risks, and you will likely be devoting a lot of capital. Be especially wary of startups that seem to generate all their cash from other investors. You could just be buying into a bubble. What most people don't realize about Buffett is that he doesn't just decide on a subjective assessment of whether the company meets certain likely vague criteria. He goes for cold, hard numbers. He is concerned with the company's balance sheet and those that represent its stock price. This is what he said.
I like to get numbers. so I'm getting reports in weekly in some businesses. But that doesn't tell me what the economy is going to do 6 months from now or 3 months from now. It tells me what's going on now with our businesses.
During the interview, Andy made mention of Buffett's stake in Apple Incorporated, which is around $45 billion. He then threw a question at him, which he answered perfectly, and gave us another valuable formula to attain investment success. Let's hear what he said.
Well, it's a long-term investment.
What you gain in this conversation is that you should set a clear investment goal and let it be on a long-term basis. You can start by reflecting on what you want to achieve financially. It might be a short-term goal like saving for a home or a vacation, but that isn't the investment Buffett wants to help you with. He talks about long-term objectives like securing a comfortable retirement while being wealthy enough to fund your children's education. These objectives will depend on your life stage and ambitions. You can't be younger than Buffett, who started investing at age 11, but if you are still young, it's better to focus on growth and long-term wealth accumulation. Moreover, older folks near retirement can also utilize this for more income generation and capital preservation. According to Warren Buffett, if you have to follow a company closely, you shouldn't own it. He said Apple is a long-term investment, which will make the investor silly if he keeps asking about every transaction in the company. In the interview, he mentioned that being the company owner for a long time made asking about what happens every day impossible. Here is what Buffett got for you.
Stocks are safe for the long run, and they're very unsafe for tomorrow. Berkshire, 3 times since I took over, has gone down roughly 50%. Did I feel poor then? No, not at all. I knew it was going to be worth more over time. American business is going to be worth more over time. That's what you're buying as a business. You're not buying a stock. You're buying a piece of a whole bunch of businesses. Are those businesses going to be worth more 10 or 20 or 30 years from now? Of course they are. But if you think you can jump in and out, or that you know the time to come in, I think you're making a mistake.
A prime example of Buffett's long-term thinking is his investment in Coca-Cola in 1988. Remember, I mentioned the brand being a household name in over 200 nations and virtually everywhere in the world. This company wasn't popular then, but despite short-term fluctuations, the investment yielded remarkable returns over the years. The mentality behind this purchase held the company forever with his belief that people would always drink it. But while setting a clear investment goal, remember to cut your coat according to your size. This means that you should take your risk tolerance level into account. What are your goals for investing? Are you comfortable losing money if the stock market performs poorly, or does any investment loss make you nervous? These are the types of questions to think about to help gauge your risk tolerance. Investors with more time to recoup market losses may be more comfortable taking risks. However, as you near retirement or are already retired, you may want to adjust your risk tolerance to ensure your investments are consistent with your goals. When Andy asks Warren about the amount an ordinary investor could have on a percentage basis, Buffett lets him know it depends on a personal situation. As said earlier, if you are working where you live off your paycheck and want to have a little cash around without maxing out your credit cards, that investment requires little capital. This is what he said about it.
Cash should an ordinary investor have on a percentage basis, do you think?
It depends on their personal situation. If you're working in something where you're living off your paycheck from week to week, you want to have a little cash around, and you certainly don't want to have a credit card that's maxed out or anything like that. At Berkshire Hathaway, we have all kinds of businesses. We own 73 businesses now, and businesses, we're looking for an entity that has durable competitive advantage.
Buffett is known to look for these 2 qualities in his buys. Still, he has also used certain quantitative measures to determine whether a firm has those qualities. 2 of those measures are return on equity and return on total capital. Buffett likes firms to have posted an average ROE of at least 15% over the past 10 years and the past 3 years, and an ROTC of at least 12% over those timeframes. Another way Buffett has examined a firm's management is by looking at how it spends its retained earnings, the earnings a company keeps, rather than paying out in dividends. By taking the increased amount in a company's earnings per share for the past decade and dividing it by the total retained earnings over that time, the result would show how much profit the company has generated using the money it has reinvested in itself. In other words, how well management uses retained earnings to increase shareholder value. This might sound off, but Buffett does invest in the market when others are panicking. This is because he understands that volatility in the stock market tends to smooth out over the long term. Even if the stock market is struggling, history suggests it will recover eventually, and you are not looking for a quick return. A good company with strong performance will likely survive most market dips. Buying stocks when markets are struggling may also help you discover undervalued gems. The challenge is to choose a company whose share price has fallen but is resilient enough to weather the storm. A good example is the crash caused by COVID-19. Many businesses have struggled directly due to this crisis, putting their continued survival in doubt. You don't want to pour money into a sinking ship. But this formula requires patience. You shouldn't be hasty about selling your stocks whenever the market drops. As a new buy, you might get your first stocks, and their share price will drop the next day or so, which will spook you into unloading them so you can minimize your loss. It would have been better if you hadn't made that decision, because they could rise over time. Giving into emotions is one of the leading ways to lose money in the stock market. If you've been a victim of emotion-driven investing, here are some strategies to help you recover. When you think of investing in the stock market as a long-term game, you'll be less likely to get thrown by individual events. The stock market has a strong history of recovering from losses. If you take a buy-and-hold approach, load up on quality stocks now and hang on to them for decades. Just like Buffett, you're less likely to get burned. You're also less likely to give in to panic every time your portfolio value dips. One of Buffett's mantras is that investors should try to be fearful when others are greedy and greedy only when others are fearful. He's lived up to that recently, while others have run from stocks during the recent downdraft. He says he's been buying quite a bit. For example, 2009, after the market had been pounded, it gained 47%, doubling the S&P 500's 23.5% return. The reason is that while other investors overreact and ditch quality stocks when times are tough, Buffett scoops up the bargains they leave behind. And over the long term, that paid off big time, as Berkshire climbed to a record high.
When a stock can be bought well below its business value, that probably is the best use of cash. It's something the Washington Post did on a huge scale back in the 1970s. Teledyne may have bought 90% or something or close to it of their stock back.
The Oracle of Omaha initiated a buyback program in 2011 and relied on repurchases in recent years during a competitive deal-making environment and an expensive stock market. The conglomerate spent a record $27 billion in buybacks in 2021, as Buffett found few opportunities externally. Repurchase activities slowed in 2023 to about $8 billion as the billionaire investor went on a buying spree with stocks selling off. Berkshire also took over insurance company Allegheny for $11.6 billion, Buffett's biggest deal since 2016. Stock buybacks have drawn criticism from politicians who believe corporate America should use its cash in other ways to boost growth in the long term, such as employee benefits and capital expenditures. Many say buybacks often provide an incremental boost to earnings per share growth, and when companies stop doing that, accomplishing that goal becomes more challenging. The Biden administration even attempted to discourage corporate stock buybacks, with a 1% tax on the practice included in the Inflation Reduction Act. But several prominent lawmakers, Biden included, don't think this goes far enough. According to Yahoo Finance, Biden suggested quadrupling the tax to 4% of the buyback amount. Let's take a listen to this.
Invested in the production to keep gas prices down. Instead, they use the record profits to buy back their own stock, rewarding their CEOs and shareholders. Corporations ought to do the right thing. That's why I propose we quadruple the tax on corporate stock buybacks and encourage long-term investments.
However, Buffett believes buybacks are beneficial to shareholders as they lift per-share intrinsic value. Buffett defended stock buybacks in his letter when they were done for sensible reasons, specifically when the stock was trading at an attractive price. As Buffett said, every small bit helps if repurchases are made at value-accretive prices. Just as surely, when a company overpays for repurchases, the continuing shareholders lose.
We bought it for a shade less, or maybe a lot less, but at least a shade less than it's actually worth. And we don't set out to buy any given amount. We set out to buy stock at prices below intrinsic value per share. And the truth is, you've got to expect good times and bad times in business.
Warren Buffett might be a multi-billionaire, but he is not infallible, which means you should expect to make mistakes and plan around them. Even Buffett admitted his mistake. The CEO of Berkshire Hathaway says that the dumbest stock he ever bought was actually in Berkshire Hathaway. In 1962, after a quarrel with the company, he bought up a controlling interest out of vindictiveness to fire the management. He estimates that this act of pettiness cost him around $200 billion in the long run. Buffett has made many other losses, running from the hundreds of millions into the billions. These include buying Dexter Shoe Co. for $433 million using Berkshire Hathaway shares, which later rose to a value of $5.7 billion. He'd also failed to offload his shares in Tesco before the company admitted it had overstated its profits, which caused its stock price to tumble. Each time he has slipped up, Buffett has been open about his mistakes and careful to learn from each one, while still warning people that he will make more mistakes in the future. If you've just started, you can take lessons here. Just because you've had some success doesn't mean you can't still lose it all with one unforeseen disaster. Buffett said, "But suppose you expect to make mistakes and hedge against them by spreading your risk. In that case, you can survive the impact because you cannot fully escape it." Warren Buffett sets the bar high for an investment strategy. His knowledge and understanding of the market have earned him his nickname of the Oracle of Omaha. Still, his success is due more to persistence and experience than any predictive power. He, too, has made big investment mistakes, but the difference is that he has ensured that he never invests more than he can afford to lose. Warren Buffett's investment principles and strategies have helped him amass an incredible net worth. By steadily following his formula, you can grow wealth and build stable and sustainable investments. If you found this video insightful, don't forget to like and subscribe for more financial tips. See you in the next one.